The Bank of Canada is holding its key interest rate steady at 2.75%. Governor Tiff Macklin says that the move will give the central bank more time to see how the U.S. tariff situation will impact the economy.
At this meeting, we decided to hold our policy interest rate unchanged as we gain more information about both the path forward for U.S. tariffs and their impacts. Monetary policy cannot resolve trade uncertainty or offset the impacts of a trade war. What it can and must do is ensure that Canadians continue to have confidence in price stability. Our focus will be on assessing the downward pressure on inflation from a weaker economy and the upward pressure from higher costs. We will support economic growth while ensuring inflation remains well controlled. Faced with pervasive uncertainty, Governing Council will proceed carefully with particular attention to the risks. That means being less forward-looking than usual until the situation is clearer. It also means we are prepared to act decisively if incoming information points clearly in one direction.
It laid out two economic scenarios for how that uncertainty could evolve. Either the tariffs are negotiated away quickly and the economy stalls but escapes with limited damage, or a lengthy global trade war sends Canada into a recession for a year. Dr. Moshe Lander, an economist and professor at Concordia University, joined us to unpack this further.
I was pleased by the move. I think it was the right move to do. I was worried that because the inflation number yesterday came in lower than expected, that was going to encourage them to cut interest rates right now. There's only a few more interest rate cuts left before they start to move into the aggressive zone. And even there, they only have a few more cuts before they run to the theoretical bottom of the interest rate cutting areas. So given that we still have another 1,000 days of Trump administration, do you really want to burn all of your interest rate cuts in the first 100 days of his presidency? At this point, the economy is not shrinking, but it's not growing particularly well. Inflation is not high, but it's not showing necessarily any signs that there's no inflationary pressure. So the best thing to do really is just hold and wait. And so when you have 6 weeks till your next decision, you get a little bit more data on the jobs market, you get a little bit more data on inflation, you'll get a clearer picture as to first quarter GDP and what was happening to the economy as a whole. And so that makes a better informed decision. And of course, the big kicker is we have an election in 10 days. And so we don't even know who's going to be in charge and what their policy outlook is going to look like and how they're going to deal with the Trump administration. Right now, he's kind of ignoring us, which is no bad thing. Is he going to be able to do business with Carney if he wins? Or with Poilievre if he wins? Is it a majority? Is it a minority? And does that give him any motivation to restart his fight with Canada? So I think this was a slam dunk of a decision. I know markets were kind of mixed as to what was going to happen, but I really think this was the easiest decision to make, which is wait and see. It's not like you're going to have to wait months and months. It's 6 weeks. What can happen in 6 weeks these days?
We also asked Dr. Lander about the prospect of the BOC increasing its key rate later down the road.
I think you'd really have to see a return of inflation in a nasty sort of way. I don't think the Canadian economy is going to grow fast enough that the worry is that the overheating economy is going to spill into inflation. It's going to be that the tariffs start to really do damage, or the uncertainty of business decision making is going to pose a problem. But even there, it would also have to be in a way that the jobs market doesn't get soft, because if you see unemployment start to really take off in response to all of the tariff damage, then that means there's a lot of slack in the economy, and that would even necessitate cutting an interest rate without that fear of inflation returning. So it's very difficult to imagine a situation where the Bank of Canada is going to have to move towards increasing interest rates unless inflation takes off. And so the good news was that we didn't see it in March. I think we're unlikely to see it in April as well. Gasoline prices continue to remain low. The oil market, the commodities market really took it on the chin last week. And so even if they recover, they're not going to recover to the levels they were, say, in February. So I don't think there's enough inflationary pressure in a commodity-based economy like Canada that we're going to be talking in 6 weeks' time about inflation at the 3% or above and sustained and changing people's inflationary expectations that an adjustment's needed.